Okay, welcome everyone. We'll start our lesson 2. Today lesson will go through LO2 learning outcome 2. As you know me, my name is Anjum Satha. Please, if you have any question, drop me an email anjum@university.co.uk and I'll try to get back to you as soon as possible. So today lesson will go through understand appropriate financial reporting framework, and please let's what you know about the financial statement. Always good to be reflect how much I know already about financial statement, how many types of financial statement we prepare in account. So we discussed in the previous lesson IAS 1, International Accounting Standard 1, which is about financial statement, how many types of financial statement we have, how we prepare. So statement of comprehensive income, which is called income statement, profit and loss. Second statement is the statement of financial position, which is known as balance sheet. And the third statement is the statement of cash flow, known as the cash flow statement. And the fourth statement we call statement of change in equity statement. Okay, so always financial statement should be represent true and fair information. Then we went through last lesson about inventory. Inventory should be recorded at cost, net realizable value, which is the sale value, whichever is the lower, like Windows 98 CDs. You bought it back in 98, 2000, and that was the high value, and but no one is looking to buy the Windows 98. So if you have in the warehouse, you record maybe 200 pound software CD, and no is only 10 pound maybe, and that's the difference is need to be put as a loss, and we need to be recorded the inventory as an asset only 10 instead. So net realizable value, sale value should be recorded, not at the cost, because the financial statement need to be true and fair. Okay, today lesson indicative content, what we'll go through, we'll go discuss about the financial performance, revenue, financial statement, group of entities, and we appropriation accounts, which we look in partnership, and we'll discuss about the chairperson, our financial statement need to be, and the depreciation method under IAS 16. That's which we will discuss property, plant, equipment. All will be in our discussion, and overall our discussion will cover all the indicative content. So liability under the company, first we have the assessment criteria 2.1, assess the application of the financial reporting framework. So when we say a limited company give the power to the limited liability and company registered in the company house under the Company Act. Company have two types, it can be private limited and public limited. Private is registered in as a private investors, and the public limited required £50,000 worth of investment registered in the company house and in the stock exchange. They issue shares to the public, and shares can be ordinary or the preference shares, and we can look around the registered capital to raise. Okay, so under IAS 1, how we can, under IAS 1 International Accounting Standard 1, when we prepare the financial statement, we look the revenue, we look the cost of sales, gross profit, and then this is the normal layout of the financial statement. And financial equity, total asset, non-current asset, then current asset, equity we look, and then we look at current, non-current liabilities as well. And this is the layout which we follow under IAS 1 International Accounting Standard 1, which is standardized throughout the world. So revenue, which is we use throughout the world, instead of turnover or sales, cost of sales, gross profit if we mind, and then all the expenses we can categorize to either distribution card or administrative cost, and then profit from operation. Finance cost is known as the interest on loans, and then tax, how much we paid, and we have the profit for the year, how much we have. So that's all, we look the profit, and that's the layout we follow for the statement of comprehensive income. Okay. Then we can move to the next statement of financial position layout. We can look around the asset. Then we non-current asset come first. Intangible is like goodwill, patent, copyright, and then we'll go through the non-current asset registered. And then we will go through the current liabilities, which we follow under inventory, trade receivable, cash equivalent. That's come under the current asset. And then we'll go through the total asset, And when we minus the total asset and it become a total liability, then it can be net current assets. Okay, so we can look around other in the equity attribute, share capital, share premium, return earning, revaluation under all equity, non-current liability, which means long-term, current liability, which is means short-term. When we say asset minus liability equal to equity, which we can. That's the normally we can lay out under IAS 1. And then we had a discussion in the previous lesson as well. Financial statement have some financial characteristics, and these should be all the relevant, capable information, all the material information should be included in the financial statement, and thus provide true and fair information to the user of the financial statement. Faithful representation, complete, neutral, and free from errors. And we look around the enhanced qualitative characteristics, comparability, verifiability, timeline, and understandability. All these, we need to be look around the qualities in the financial statement. Okay, so financial statement notes also under IFRS, International Financial Reporting Standard. We look the accounting policies and the principle, and we follow true and fair information, and the companies are allowed to share, established reporting policies without the good reason. So you have to give, and a depreciation come under IS 16, and depreciation are disposal. So assets should be recorded in the financial statement. Disposable, depreciable amount, carrying amount should be reflected, residual value, and because the financial statement need to be true and fair, as we discussed in our lesson. Irrecoverable bad debts. What is the bad debt? Bad debts is the money which we can't recover. It is known as a bad debt. Allow irrecoverable bad debt and doubtful debt. Those need to be make adjustments. So financial statement should be true and fair. It can be only when we have all these information according. Anyone any question here, please? Okay. Irrecoverable debt, sale, ledger control, because always please when you do these two words, remember guys, those are is quite crucial, so we have to look around double entry bookkeeping rules. Okay. So look around double entry bookkeeping, the word debt and the word click. So use these two words, please. So what D is the debit, is expenses, we do debit, and A is the assets, we do debit, and I we do debit. What we do credit, C is the credit, L is the liability, yes, I is the income, and C is the OTHM. Okay. Then please, when we do debit these, when these are increased, yes, when these increase, we do debit. Opposite debit is a credit. If asset you need to reduce it because you sold it, you should do credit instead of debit. Yes, or if it's the impairment, the value of the asset. So please keep in mind the double entry bookkeeping rule when you're making. So irrecoverable debts is irrecoverable is expense. So we have to reduce our trade receivable, which is mean our asset. So like which we call debtors, trade receivable, sale, ledger control. That's we've been given the entries. Yes, that's I mentioned like irrecoverable debt. You reduce your receivable, and allowable allowance, which is if it's a provisions we can estimate, so we can create and we can allowance. So we can put it as allowance doubtful debt as expense, allowance for debt as a provisions, the credit, and when it actually happens, we cover it. So we can make adjustment accordingly. Okay, guys. Then we have please accrual and prepayment. Accrual and prepayment or accrual concept. Each year income and expenses should be recorded. When your accrual and prepayment need to be adjusted, when is the first place, you always ask first place. Expense is a debit and accrual expense is a credit. Accrual mean expense incurred but not being paid. Like gas, electricity bills, it's received after the so it's not being paid. So debit the expense, you should record within the year. You not make the payment, you create the liability. Prepaid mean advance paid, and if you paid advance, but that's not like car insurance. and you're closing your year end, 31st December, first fourth, and then you should be prepaid is your asset, and you have to first place you record debit the expenses and credit the cash, because the cash went out from the business to make the payment. So now, because that's the prepaid for the next period, so you have to do the credit the expenses to reduce it against it for this year accrual basis, and then debit the prepaid, because the prepaid is still your asset, because on even the money is held by someone else, but you not consume it. They are legally bound to give us money back. If you sell your car, the money you paid for towards the insurance, you can claim back. Okay, so exactly we can think about accrual and prepayment in terms of the income, accrued income. So first place, think about when you receive the cash, you debit the cash and credit the sales. But if the accrued is mean yes, so we have to look around increase. So accrual income will be credit. We can look around, yes, and then under the profit and loss, the increase the income earned but not received. So accrued income will be debit and income will be credit, because income earned but not been received. And the in term of accrued expense incurred not being paid, which is opposite side of So that's really we need to be look around and we need to make adjustment. Okay, prepaid is mean advance. Maybe you have received the cash. Cash is the income, sales is the credit, but actually that's not in term of, so you reduce your sales, you have to do the debit first place, because that belong to the like construction contract. You not completed all the work, so half you can say income for this year, or rest you can create a liability, which is because if you don't, until you don't complete the work, even money you are holding is not your income yet. Okay, so please always good to be use the timeline and proportion accrual and prepayment, and the expense accrued expense is a liability, debit the expense and credit the accrued. Uh, then accrued income is the asset, accrued income is debit, and the income is a credit. Uh, Instead of, you see there is in expense is accrued is the credit, income is the opposite, of course. So you have to look around. The prepaid is mean advance paid is the asset, so prepaid expenses will be debit and the expenses will be credit, because we're reducing the expenses. In terms of income, because the income will be debit, you're reducing, and prepaid income is your liability, so that's here no credit. That's the really we need to be look around, and I included some examples for. Please always, when you do the entry, double entry bookkeeping and the making adjustment, always look around the like original entries, maybe the reversal entries at the principal, like income and expense, you treat each other way around, so you have to make reasonable adjustment. Error of commission, you charge to the wrong, error of commission, error of principal. So these are all the errors you need to be adjusted to become the financial statement, what we said, true and fair. So errors can be traced in the trial balance if the double entry not balanced, to with, otherwise untraceable. If you charge, error of principal, difficult to. So you have to be make sure, go back to the invoices, look, and omissions, you miss things, that's difficult to trace. The suspense account is a temporary. So these errors we need to be adjusted. Okay, suspense account, which is normally we create as a temporary account to make, that won't go in the final account. Okay, strength of the weakness of the financial framework preparation. Of course, international accounting standards and the framework provide you guidance on why we need to be look around true and fair information, and that help to achieve the objective of the financial statement. Qualitative characteristic about financial useful information, the definition, recognition, and measurement element, which the financial statement and constructed and examined by the levels and the concept of capital and capital maintenance examinable for this level. So we need to be look around the underlying exemption, faithful representation, neutral, free from error, and all the information should be going concern the business will carry on as a normal for unseizable future. We look around the journal acceptable accounting principle and the rules, and qualitative characteristic about financial statement, like comparability, timeline. Yes, these all we discussed earlier. And true and fair under IS1, and the objective of the financial statements, it's a historical figure. People can make the decision, and it's the economic decision based on the true and all the material information should be included in the financial statement. Okay, anyone, any question, guys? No question. Let's move to the next one. Okay, interested party. Who are interested? Let's look, please. 2 minutes. You can chat in the chat box. Okay, so it can be investors, it can be existing lender, implies all these are interested party and they have different interests, so we have to look at the different users and the stakeholders, what interests, all the information, it need to be true and fair. Okay, guys. Next, we're looking 2.1, which is about the merit criteria, and we look the financial ratios to measure the performance. So please, different ratios we can look around the profitability, liquidity, use of resources, which further we enhance in the next lesson as well. Yeah, we went through, and then please 2 point. So gross profit divided by revenue, or we call sale or turnover. And we have two companies, Anika and Papika, then we made in the performance. So in your assignment, we can add the example and we can look around. Papika is, Anika is 45% and Papika is better than Anika. Then operating profit margin 9 and 11. So difference between that's your overhead expenses. So that's been, the gearing ratios of is high gear, high risk, we're looking debt divided by debt plus equity, because normally the long term debt is you for investment purposes, you borrow money. So 13.26, and the other company, Papika, 71%. Alternative debt divided by just equity. There are two formulas that, we have. And then we look the interest cover ratio is 11.6 times. Is their profit is higher than the finance cost interest 3.1 times, and the asset test ratio is 1.2. Normally benchmark is one, and which is mean, indicated the high risk company. If we look the company's performance, maybe compare with the previous period, it's better to be same industry, same period. We can do horizontal, overcome the problem of vertical analysis. That's, sometimes is difficult. It's a common to compare and the company performance for the particular period, which we need to be look around. Let's spend 2 minutes, please. Can we look, what is the horizontal analysis and introduce it's the independent yardstick of comparison. However, it pick similar size of the company, same industries. If I'm doing next, I can do Marks and Spencer or Primark, because it's the same industry, almost the same size of. It's not to be compared with the corner or the small shop, because their ratios can be, and that's not a good comparison to the performance, and you decide, which one is the best. Okay, let's please, can we look the industry averages? Go through these one. Yes, we can look around the calculate the specific ratios, print the schemes, average ratio equivalent to two companies, then scheme. We can look around the context of the analysis, why you're doing. Please always not just look the performance in terms of the financial ratios. Always look the political, economic, social, technological environment, macro, how this will affect your business as well, not just for the sake of consider the business strategy. The ratios may show the particular weakness in the company. As the business is the plan, deal with these weaknesses, turning the business around and making the changes can be, and sometimes things maybe get worse before better. And we can look around the impact of each decision, like in AI, using investing money. It can be impact on ratios, but in the long term can be bring benefit. Okay, the users of the financial statement, please. Let's, we spend 3 minutes, please. We can read. So look, everyone's different interest, of these stakeholders and what purposes they can use the financial statement. Yes, so public is interested entity to provide the local jobs to the local people, and they look in the investment, they look, the contribution of the tax. Customer want the quality product and the guarantee if they're giving the company the facts financially. So as we discuss about Anika and Papika, these are the two companies. We look around their profitability, we look around their uh, gross profit for Pika is better, operating better, Anika's gearing is better, uh, uh, interest cover is a better, and etc. So on the basis of these, we can say overall Anika is a better than Papika. So we invest in Anika, and that's is our final decision. So please, I included some question. If you look Osborne chapter 6, please task 6.3 and 6.4 are the relevant our discussion to the lesson. And please, if you have any question, you can drop me email, and please hear the links as well for you. And if you have any question, drop me email anjum@ukversity.co.uk. And thanks for attending to the lesson, and hope all those are listening. Please, if you have a question, you can drop me email. Thank you. Have a lovely weekend. I'll speak to you during our next lesson when we'll go through LO2. Thank you. Bye bye.